IVM.
Imagine having a roadmap to financial freedom, where every choice that you take takes you closer to securing your legacy, creating a lifestyle you love, and building potential wealth that can last for generations. Wealth management isn't just about accumulating riches. It's about crafting a life of stability, opportunity, and impact. Welcome to Finance Flashback, brought to you by ICICI Prudential Mutual Fund. I am Parthul Shannon, and in this series, we dive into timeless financial lessons from history, showing how smart money management today can lead to a brighter financial future. Today, we're exploring how people from ancient civilizations to medieval merchants build lasting wealth, often using strategies that are still relevant. And remember, you don't need to be royalty or a tycoon to apply these ideas. With a bit of planning and knowledge, anyone can benefit from these timeless approaches. First, let's go back to medieval Europe and manor system. Lords and nobles owned extensive estates where they would let serfs and tenants work the land. Now, these lords didn't just leave their land to sit idle. They made it generate ongoing returns, something like an ancient version of passive income. By allowing tenants to work the land, they received crops, goods, and sometimes even payment in exchange for tenancy, creating a consistent income flow. Over the time, these estates grew in value. When the lords reinvested in more land and made improvements, the value increased further. This compounding effect turned their initial investment into a lasting legacy that continued to grow and provide income for future generations. In today's terms, it's like investing regularly in a mutual fund. Each small contribution may feel insignificant, but over the years of growth and compounding, it can become a substantial amount. It's wealth building that grows quietly but powerfully, like the manor lands of old. Moving forward to the Renaissance, merchants and bankers in Venice and Florence were clearly the champions of diversification well before modern financial advisors began emphasizing it. They didn't put all their wealth into a single venture or asset. Instead, they invested in various types of assets, including art, real estate, exploration, and even expeditions. Florentine bankers, for example, often backed risky trade expeditions, spreading out their resources to lower risk and increase potential returns. They knew that a failed expedition could mean losing a significant sum, but a diversified portfolio of investments helped balance those risks. Today, hybrid mutual funds operate similarly by pooling money to create diversified portfolios across various assets. These merchants understood the risk of putting all eggs in one basket, something that mutual fund schemes offer better to modern investors by balancing across sectors and regions. And for those with higher financial ambitions, certain schemes pool resources to tap into unique, high-growth opportunities like small-cap schemes, much like the high-stakes ventures that merchants backed centuries ago. Going back even further, the ancient Egyptians were the masters of preparation and resource management. Pharaohs, despite their immense wealth, valued careful planning. One of the best examples is their practice of building grain silos during good harvests to store surplus grains. Grain silos are basically used by manufacturers in the agriculture business for bulk storage of grain. By doing this, they ensured they would have enough resources during times of drought or poor harvests. This not only safeguarded their wealth, but also maintained social stability. A little peace of mind for everyone. This ancient strategy is similar to our modern concept of emergency fund or rainy day fund, as you call it. Whether it's a market downturn or a personal emergency, having a financial safety net keeps us prepared. Fast forward to the 1600s and we see the birth of joint stock companies in England. Merchants pooled their funds to finance massive trading ventures, especially for the long, risky voyages to the New World. This structure allowed them to share both the risks and the reward with other investors. If a voyage succeeded, everyone shared the profits. And if it failed, the loss was shared, minimizing individual risk. And here's an idea for those looking for something tailored and strategic. Consider that in today's markets, expert wealth managers work similarly to those merchants of the past, offering unique, individualized portfolios with more specialized investment options. They work closely to identify high potential opportunities while balancing risk. It's a modern twist on a time-tested practice. In our own lives, we may not be planning for a throne, but estate planning, wills, and trusts are still essential. These help ensure that our assets are smoothly passed on and protected. Just like a king planning for succession, setting up a plan lets us protect and grow wealth for our loved ones, creating a lasting legacy. So what's the takeaway here? Whether it's the lord of a manor, a Venetian banker, or an Egyptian pharaoh, these historical figures knew that smart wealth building requires strategy, diversification, and foresight. In today's terms, that's where compounding, diverse investments like mutual funds and specialized financial service come into play. They help us navigate modern markets while applying age-old wisdom. That's it for today, ladies and gentlemen. Thanks for tuning into Finance Flashback, and remember, financial wisdom is a journey, and every step forward builds a stronger future. Until next time, stay smart and stay invested. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
IVM